Welcome to It's the Economy. The street has been getting a little worried about asset quality of financial companies. RBI was the first to flag it, actually, when it raised risk weights on unsecured loans last November. Since then, microfinance companies and private banks have been showing some signs of stress. My colleague Abhishek Kothari actually calculated the slippages at private banks. And he says after Q1, it rose by 10.9% quarter on quarter. In fact, they have done worse than PSU banks. Some MFIs have done much worse, and that data will run for you. To get an idea of how retail loan growth, that is a quantity and quality, is progressing, I have with me the ultimate guru of retail asset quality, Rajesh Kumar, Managing Director and CEO of TransUnion CIBIL. Rajesh, good morning, and thank you very much indeed for sparing time for us.
Good morning, Latha. Thank you very much for having me on the show.
Well, you all gave us one report in January, CIBIL, where you clearly showed that both quantity and quality of retail assets was fraying a bit. And quantity obviously was going down because of the Reserve Bank's risk weights. What has been the performance in the first 6 months? Has quantity gone down further, retail loans, and more importantly, quality?
Yeah, Latha, absolutely. I think, first of all, there were very definitive interventions from the Reserve Bank for all the well-known reasons in November last year. So that's obviously led to some remix in terms of product composition on the lending side. And I'm going to use the word moderation in some segments, and overall a little more conservative or cautious approach overall. But I think there are a couple of factors at play here. A, obviously, the Reserve Bank policy changes, which are very timely and proactive. And secondly, as we all know, the existing credit deposit ratio, where the ratio is still pretty high. So when the ratio is high and your incremental cost of deposits is higher, obviously it means that you're relooking at your product mix in terms of the desired goals on the net interest margin versus credit cost. So almost every lender is rewriting their product mix and the capital allocation for products. So all of that leads to some of the changes that we are talking about in terms of some change in growth rates at a product level. The change, more importantly, I think some people often ask, is there a decline in the retail loans books, etc.? So the answer to that is the growth rates are pretty much intact. Intact in the sense we are still growing. I mean, India has so much headroom for growth. So we are pretty much growing. It's just that the growth rates have moderated. For example, if a product was growing at, let's say, runaway 30%, that would have moderated to a 20% or 10%. And obviously, the biggest drop is in unsecured loans below 50,000 and credit cards as well. So that's the overall trend in the. Oh yeah, one other important point, Latha. So when we talk about growth origination, I think it's also important to look at the trend in terms of quarter on quarter, or for the same quarter a year ago, how is the growth rate, right? I think this is super critical because this sets the direction. I say that also from a risk perspective, because invariably delinquency ratios are a function of how the numerator, that is new delinquency, comes in versus incremental book size. So as the latest quarter growth rates are sharper or lower, more low than the previous quarters, then the growth rate of the overall industry retail book will come down. Again, it is still growing, but the growth rate will come down.
Yeah, I've in fact got your table on newly originated loans, and across the board, one can see the reduction. Credit card in particular, April-June 23, 7.8%, and April-June 24 is minus 29.6. So clearly, there are some people who are pulling back. But what about quality? I guess that is the bigger fear. Retail is still the trade, the go-to trade. I have not heard any banker trying to sing praise of corporate credit just yet. It's a very crowded space. NBFCs, banks, P2P lenders, fintechs, everyone is in the retail trade. So are you seeing in the last 6 months more worsening of asset quality?
Actually, no. I think we have some good news through all of this. I know last year we spoke about some stress in the very small ticket personal loans, etc. But like I said, the timely interventions, there is good control there. In fact, some of the delinquencies are even improving. So first of all, overall on the industry retail book, Lata, I think there is good stability. In fact, if you take auto loans, home loans, two-wheeler loans, all these products, in fact, there's even an improvement in the overall delinquency to start with, the latest quarter numbers. A. B, in unsecured consumer durable loans and credit cards, there is it's almost the same or there is a marginal increase in delinquency. But when I say marginal increase in delinquency in some of these consumption products, one has to keep in mind on balance two factors. One is we had the severe heat waves in April, May, which definitely affect collection efficiencies. And B, also remember the point earlier that in these products, the new product growth is slowing down the growth rate. So to that extent, delinquency percentages also will be a little higher because now you have a situation where for 2 or 3 quarters, the rate of growth of the delinquency or the numerator will be more than the rate of growth relatively of the book size. So 1 or 2, 3 quarters, we will see that normalization process.
Okay, so total number of loans given is less in that category, and therefore the delinquencies as a percentage will show up higher, is what you're saying.
Absolutely, yeah.
Right. Okay, last time in the January 2024 press release that you all gave us upgrade downgrade numbers.
Yeah.
And even in prime quality loans, there was the amount of prime was declining. You had a slight increase in the downgrade numbers in September 23 compared to the previous quarter.
Yeah.
Would you be able to help us, whether upgrade downgrade ratio is in favor of upgrades?
It's absolutely consistent and stable, Latha, between the overall upgrades across the industry. And then when I look at delinquency rates, particularly, within each band, say above prime, prime, subprime, etc., these categories, within those categories, again, it's pretty much stable. And and normally I wouldn't want to kind of worry too much when there is a 10, 20, 30 bips difference. Those are seasonal and they kind of normalize pretty soon. I would only if sustained over 2, 3 quarters, the dimension of the change and the direction of the change is negative. The good news is that as of now, we don't see any such trends. Latest quarter, credit cards saw a 20 odd bips increase in delinquency, again expected. And credit cards specifically, I think, is a slightly different issue. There is this growing hypothesis that a lot of the good spends of credit cards have moved to the UPI world. So to that extent, some increase in delinquency in cards is kind of expected. But again, I think there's a lot of normalization process there. And lastly, since we're talking about portfolio quality, Latha, like I said, the latest quarter origination plays an important role in the growth of the book size. Likewise, when we talk about delinquency, I think it's very important to look at two factors. First of all, the early delinquency, right? All the recently acquired books, how are the delinquency trends? Because when the book is new, if it shows early signs of higher delinquency, then we know what we are heading for. Again, good news there. The early delinquency percentages are pretty much stable and consistent across products. Like I said, again, just some 20 odd bips increase in credit cards. And likewise, when I compare different vintages, when over the past few years, when the loan books were 3 months old, 6 months old across products, what was the delinquency, let's say 30 days past due at 6 months vintage, 2, 3 years back versus now? I don't see anything alarming at all. Like I said earlier, the theme remains all secured products, good improvement, marginal increase in a couple of these small ticket products, which I think will normalize soon.
Okay. There is one last fear that I want to check with you, that younger cohorts of borrowers are actually borrowing money on their personal loans account or credit card account and playing the stock market. There is enough data that investors in the stock market are of much younger age, and those in FDs and mutual funds are older. Do you notice more delinquency in the younger age groups?
Actually, I haven't seen any marked change on an age cohort, Lata. And as to your earlier point about more investments into the market, etc. Unfortunately, while we hear about these from the industry folks, CIBIL doesn't have visibility to the end use. And of course, unsecured loans, it is difficult indeed to monitor the end use. But coming back to your question on the younger cohort, we haven't seen any specific increase in delinquency because of a younger age group. But that does bring me to another point in turn, which is kind of linked. That new to credit. So the overall share of new to credit customers in new originations has come down significantly. I think perhaps because of some of these apprehensions, these are all early trends, and I think everybody's watching closely. And so share of new to credit has come down. That for me is worrying in a different way, because given our country's demographics with 70 crores population below the age of 28, very low credit to GDP ratio, very low house, home, two-wheeler, car ownership in India relative to the developed countries, etc. Given all of that, if new to credit comes down, so to give you a number, the share of new to credit customers in new originations used to be 12, 13, 14% about 12 to 18 months back. That has dropped to 6% now. So we're doing half the number of loans that we used to do to new to credit. So clearly conservative. And that's what, when I began our conversation, I was saying there's a little bit of resetting of risk appetite and product mix.
Okay.
And typically when you reset your risk appetite, you want to go easy on the small ticket, perceived higher risk, higher return products. A. B, you want to be a little more careful on approval rates. C, you want to be careful on new to credit because there's lesser information to confirm the probability of default, etc. So new to credit has reduced significantly.
Okay.
And that will in turn pass on to the younger population inevitably.
We are running that data. Auto loans, for newly originated loans, it was 9.8 year ago. Now it's 1.5. I mean, down the line, the new to credit has clearly decreased. So the big worry for the industry should be that growth may be affected because of higher caution and not worsening of quality. Just a very quick, short answer from you. You've looked at credit quality over the years. Are we at worry zone at all, or are we at the best of times?
Oh, not at all. Definitely not in the worry zone, Latha, because in fact, when I talk to all my industry friends, we say over 20 years, the kind of ratios we have seen. So that's why I keep telling everybody, including in my teams now, that whenever we talk these numbers, let's put a column next to it to say, what's the long-term average, right?
Yeah.
Are we well within the range, or in the long-term average, we are in fact more near the bottom end of the long-term range. So which is good news.
And where are we?
We are more close to the bottom end of the long-term range.
Okay.
So that's why I am not excessively alarmed. And things like a little bit of an increase in a few products like unsecured, this is the nature of the business. It's a lending business. We are going to see some opportunities. All of us will want to go do business there. It will lead to a little bit of over leveraging. The regulators and the risk management will kind of slow that down. And again, we moderate that. That's a cycle, but absolutely not in the worrisome range at all. Nowhere close to that.
Okay. Thank you. Thank you very much, Rajesh, for putting investors and financial market experts and regulators at ease. We are at the bottom end of the asset quality problem. So not to worry about asset quality, maybe a little bit of worry that loan growth may suffer because of excessive caution. On that positive note, we wrap up on Bazaar. Thank you very much for joining us. Chartbusters coming up after a break.